Give me stop it. Give me stop it. Hey, hey, girl. Hey. You know, as long as I can be inside, we're gonna be good to go. Hey, y'all. And I am the Shanita Johnson. Well, I shouldn't do that because it's a lady locally that does this. I don't want to steal her move, but I am the Shanita Johnson, licensed real estate broker in the states of the great state of Tennessee and Mississippi, serving specifically the Memphis Metro. That's all. Yeah, yeah, with some absolutely. Yeah, write it down because I think we talked about that before. When you write it down, and I got my pen and paper, I have my actual pen and paper this time, pen and paper. I already notes.
Good, some good stuff.
Yeah, because when you write it down on paper, you write it on your brain. So anyway, let's stay focused. Let's stay focused. Okay, so today I am talking about a group of people that I really adore, and that
Your
is,
children?
yeah, I adore y'all too. What I'm talking about the people um, who I don't spend money on. Their pause was kind of, that was kind of suspect, wasn't it?
Such a lackluster tone. It's like, yeah, I guess I adore y'all. It's okay. Well, tell us about your other group of people you adore.
Okay. So I would adore wouldn't be a word that I use to describe y'all. Is that better? Because
Okay,
that's not a word that I use to say, oh, I just adore my daughter. I just adore my son. Like,
we
so
got it. You don't
so
adore us.
maybe that's it. Let me clean that up. Okay. But the people that I adore, the group of people that I adore in this real estate industry are first time home buyers. And the reason I adore first time home buyers is because they have all the questions, they have the curiosity, and sometimes they make me laugh because first time home buyers make me laugh because they get information from all different sources, and some of it borders on ridiculousness, seriousness, and foolishness, or it borders on wisdom from 20 years ago. So
I feel
what
like a good thing for you because you are really good. You have a teaching spirit. You're really good at that. An educational spirit. So I feel like that's like the perfect group of people for you, especially if they're always coming with questions and stuff. That's like a good area of people for you.
so yes, I do like explaining stuff and helping people understand things. There's a and I'm gonna get to my point in a minute, but I just heard this today, so y'all gonna get it too. This one of the coaches I have, mentors, whatever you want to call them, he says one of the hardest things he has to do is take an idea that he has out of his brain and putting it in somebody else's brain. Like that's the most challenging thing to do when you teach. And so I kind of feel that way sometimes with first timers, but guess what? It's all good. So one of the reasons, like I said, I adore first time home buyers is because of the questions that they have. And I love it because it gives me not only as you mentioned when you are a teacher, it forces you to learn things, right? It forces you to learn because if you don't know anything, you can't teach it. But one of the things I want to talk about when it comes to buying a home for the first time is I want to dispel a couple of myths and try to get the whole idea, the whole HGTV idea out of people's heads. Because for the majority of people, the first home that you buy is not going to be your dream home. That's number one. And guess what?
Wasn't in that majority, but yeah.
And it's okay. That is okay that your first home is not your dream home. The second thing I want to talk about is you have to be realistic. And when I say be realistic is when you have a vision that you got offline of what the experience is going to be, and then when you get the reality of what it's going to be, those are two different things. Going back to the show that I just mentioned, I don't want to keep saying their names because I don't want to owe them no money. But the show that the house buying show on TV, they have to condense home searching in like 22 minutes.
Yeah.
And these people they see three houses, they write an offer, they get a letter, they do an inspection, and they move in 22 minutes. It's a lot that goes into it. So
And they're
get
only looking at three houses.
right. Well, they're only showing three
Right.
houses
Only showing the three houses.
because the reality is majority of people look at between 5 to 10 houses before they make their decision, right? Um, yeah, and so just getting dispelling those myths, but the biggest one I want to focus on today is your first home is not may not be your dream home, and that is okay. And I want to tell a story about one of my clients because her first home was not her dream home. It was a home though. So her very first home that she bought was, and I wrote it down because I didn't remember all the details. But the first home that she bought, it was a 3 bedroom, 2 bathroom home. It was 1,000 square feet.
Okay.
It cost $79,000. It was it was in a decent neighborhood, decent area. It was good for her at the time.
That'll
She
get
was,
you a shack up here.
and that's
79,000.
another thing. Like you can't compare markets to. You have to know
Yeah.
your market. So $79,000, and this was a few years ago that she bought this home.
Okay.
Her first home, 3 bedrooms, 2 bathrooms. It was 1,000 square feet. She paid $79,000 for that house. The house was it was a great house. It was sound. There were no issues with it, nothing falling apart. It even had a swing set in the backyard for children. She didn't have children. She was a single woman, so she didn't need that. But she had this home. $79,000, bought it on the cove. Again, it wasn't her dream house. It didn't have a garage, but she lived on a cove. It was a good space for her. Stayed there a few years. Second home she bought. It was a 3 bedroom, 2 bathroom, had a garage, and it was in a decent neighborhood, another neighborhood that she wanted to be in. So it was like a step up for
And
her.
yeah.
So it was still 3 bedrooms, 2 bathrooms. This house cost her $128,000.
Okay.
It was 1,200 or so square feet. So she stayed in that house a couple years, sold that house. She bought her dream home. Now, her dream home that she bought a few years ago, it is 3 bedrooms, 2 bathrooms, has an office, a garage, and she's on an acre of land. In that house, she paid $239,000 for. So, said all that to say, your first home does not have to be your dream home.
It's just a
Because
step in the right direction.
right, because what she did was when she bought that first home at $79,000, that was her building wealth, building equity. She not only was she saving money when she saving on rent, because her rent at the time, I want to say it was like 850 or something, and she was living in a two-bedroom condo, two-bedroom townhouse. I'm sorry. She was living in a two-bedroom townhouse, and her rent was around, I think it was like 850 or something. But she bought a three-bedroom, two-bathroom house for $79,000, and her mortgage payment was less than her rent.
So
She
she
stayed,
definitely saved. Yeah.
yeah, she was it within her budget. She didn't stay there forever. But what it did was, and this is another thing that people often are missing. I'm sure you can speak to this too. When you are a homeowner, the cost of insurance is cheaper. The cost of a lot of things are cheaper. Not only your life insurance, your health insurance, your car insurance. When you are a homeowner, you pay less for things.
Yeah. My husband, we ended up our once we bought our house, obviously we had to get the year of insurance, and he ended up bundling it with his car insurance. His bill went down.
That's so don't feel like don't feel like one lady told me um her budget was, she could afford $120,000 home, right? In Memphis, you can get a home for $120,000, a decent home, right? But she didn't want to, she was living in an apartment, and she wanted to get out of that neighborhood and go to another neighborhood. But the neighborhood that she wanted to go to, her budget would have had to be 250,000
Oh, I think I lost you. Hold on.
Nope, I can still hear you and see you.
I couldn't hear you for a second, but I got you.
Okay.
I'm back now.
Okay. Yeah. So don't let the small beginnings or the humble beginnings deter you from purchasing a home. Because like I said, this young lady I was working with, her she could purchase a home for $120,000, and she wanted to be in a particular zip code in a particular neighborhood. But in order for her to move into that neighborhood, she would have had to make more money, which she didn't at the time. And so this is my suggestion was to her was this. Okay, you're already living in this neighborhood. There is a there is a duplex that is not far from the apartment that you're living in. One side of the duplex has a tenant in it. The other side is vacant. And this duplex is only $80,000.
So you
You
could
can,
be a living landlord type situation.
yes. And that's what I
Yeah.
told. I said, you can buy this property, live on one side of it, and this person is paying the rent. I said, you don't have to stay there forever. You can stay there maybe 2 years. I said, in 2 years' time, not only will you have money saved, and you'll be saving money because your mortgage payment is going to go be less than what you're paying in rent. And you're also going to be getting money from this tenant. So
Right.
you'll have the income to purchase the house in the neighborhood that you want.
Right. And
Her
like even because if you're getting if your mortgage payment was way less than whatever your renting price is, you can charge whatever you want for rent. Most of that money would go towards your mortgage payment anyway, so your mortgage payment would be even less than what it really is. So you would save a lot of money doing it that way, and then in the future be able to go where you want to go.
And that's how I explained it to her. But you said something, I want to correct it. You can't charge what you want to for rent. You have to be within market value. Like it has to be.
It's something new.
Yeah, you
It
can't
seemed
charge.
like they be trying to charge whatever they
You
want
can't.
for
You can't
it.
charge. You can't just make up a number. Say, oh, I think you should pay me $5,000 for rent. No, you can't do that. It has to
Well,
be. It has to be within the market value. So
well,
that's
go in because what about I have a question. So for first time home buyers, what if if you are solely buying a house not for your primary residence, are you able to buy your first home as a rental property instead of a primary residence?
yes.
Really? And then so
But it's a
how are they
different.
charging the rent? Like what do they go? You said market value. Is that just based on other rental properties in the neighborhood? Is it based off what a mortgage would be? Like, how does that work?
So you asked a couple things. So the first question, the first thing I want to address, if you purchase a property that you will not be living in, a non-owner occupied property or a rental property, investment property, whatever you want to call it. When you buy a property that you don't intend to live in, you cannot get the type of loan that you would get if you were living in the property. So you can't get an FHA loan for an investment property. It'll be a it'll be a conventional loan,
Okay.
right? Because FHA says you have to occupy. Even if you buy a multi-unit with it, which you can buy a duplex with an FHA loan, but you have to live in one of the units.
Got it.
You can't rent out both of them. Okay. So, and there are other types of loans that you can get, like a DSCR loan, you can use to purchase a property that you don't intend to live in. Okay, so that's one. You get that type of loan. Your down payment, depending on the loan type and the lender, it could be 10 to 20% down, depending on
Okay.
that. So that's the difference when you're buying a property specifically for investment and not to live in. And then the last thing you asked was about the rent. So the amount of rent you can charge is based on the market value. It's not based on what your mortgage is. So it's based on what's in the area. So I'll give this example. There's one property in particular that I'm thinking about, one of my clients purchased. The the rent in the area is between 1,000 and 1,300. So, and that's market value. The market values are based on Fannie Mae guidelines, which are released every year. Fannie Mae is the housing agency, right? So every year there's the fair market value rents. Those numbers are released every single year. Usually, I think October, November, sometime for the entire country of what market rate is based on bedrooms. So that's how you determine the rent, what the rent is. So for this particular property that I was talking about with my client, the rent range in the area that she bought this property was between $1,000 and $1,300. So she can charge anywhere in between there. And where we landed at is about $1,150 because of the size of the home.
Are you
So
able, is there a minimum? Does it have to be whatever that, because you said it's between 1,000 and 1,300 with the market value. If she wanted to, would she be able to charge less than 1,000?
yeah, she can charge. Yeah, now that part, yes, you can charge less than market value, but not more. Because if you try, let me say it this way: you can try to rent your property if the market says the rent is between 1,100 and 1,300, and you say, "Oh, I definitely got to get 1,450 so I can pay all, so I can make some money." You can do that if you want to, but your property is going to be vacant.
Because it's too high.
Yeah, if everything in the area is saying 1,250, 1,275, and yours is 1,450,
No one's coming to you. Yeah.
no, it's going to be sitting. So it's
Especially if you're not adding any value.
right, right. So you have to be with the market value. So, and that was what you just, and going back to my point, when I suggested that to the young lady, that hey, you can buy this duplex, $80,000. It's not at the top of your budget. You can stay there 2 years, save some money. Then you can go to that neighborhood that you want to. And not only that, you can take the income from this duplex and the income from your job, and you will be able to afford the neighborhood that you want. Her response, oh, I don't want to live in a duplex. I don't like this neighborhood. I don't want to stay in this neighborhood. I'm trying to get out of an apartment. I've been in an apartment all this time. I said, well, that's an option. You have the right to do that. I said, but every lender that you've talked to has told you your budget is 120. And unless you get another job or move to a different county, that's your options. That was 4 years ago. She's still living in that apartment that she was living in 4 years ago.
But she could have been close to like done
So
and
she
did
could
duplex
be,
by
she
now.
could,
She could be out.
if she had, yeah, if she would have bought that duplex 4 years ago, she could be living in the neighborhood that she wants with her two-car garage, her 4 bedrooms.
And wouldn't she be able to rent out
Yeah,
the other side?
and use that income.
Yeah.
So
Well, I'm glad I know all this stuff because that's what we plan to do after we're done with this house. We'll turn it into a rental property, and it already has some of the specs because it used to be a rental property.
yeah.
But yeah, okay,
And so that's so when it comes to buying your first home, know that it does not have to be your dream home. Like real estate is a tool, just like life insurance is a tool. Real estate is a tool. Buy smart. You don't have to buy your dream home the first time. You don't. I just showed you my client. She bought 3 homes as a single woman. First home was 79,000. Second was 128,000, and her dream home she paid $239,000 for.
and wouldn't I know we're going over
And
time, but real quick,
she's still a young woman. And
yeah, and
she did this within 10 years.
that and like we're running low on time, but the you mentioned her equity because she's earning equity with each of those houses, and you can use that towards the the next house.
Yeah, you can take that. Yeah.
Yeah, that's
Whatever.
a really really smart idea. I
Yeah.
mean, that's what similar to what we plan to do. Just stay in our house for about 5 years, go on to the next one, bigger and better each time until we get to
The dream house.
yeah
Because especially if, and I know we have to move on, um, especially if you have never owned anything before,
experience.
if you've never lived on your own, or if you've never owned anything, if you've never had to be responsible for maintenance on a home, it will it I think this is my personal opinion. It makes sense to go stay within your budget or just below your budget and get the house that you can afford, not the dream home first. Get yourself used to calling a plumber when something leaks, calling the HVAC company when your AC goes out. And so you can see what that looks like. And then it also gives you time to save money in that
Yeah,
first couple of years. Because again, your rent payment is probably here. Your mortgage payment is probably going to be here. So you're going to be able to save that. So
yeah.
yeah.
It's experience. We've gotten a lot of experience with
Yeah.
her. Even small things I never would have thought I'd have to call 311 to do something for our house.
Yeah.
I've never thought I had to be like, hey, 311, can y'all get somebody to cut this tree down because it is a fall hazard. And it was dead in the center. And it could have fell on our house.
Look,
There was a tree. There was
can't
a
hear you. Move my
you
glasses
can't
off.
see.
I can't hear you. Let me put my glasses on.
Real quick, and I'll move on. There was a tree in our back. There's a house adjacent to us in the back. That backyard is facing our back deck. And they had a giant tree in that backyard that was looming over all the cars in that area and over parts of our house. It
The
provided
one on the right.
shade. Yeah, it blocked out light and it provided shade and also pests. But the issue was there was storming real bad and we were scared of it falling over. I called 311. Never thought I'd have to do that. They came, the
What
city
even
came.
is 311?
Yeah, and I'm like, what? I don't know where I got the information to do it to call 311. I don't know from, but it was who I called. I was
Yeah.
like, city, fix this. And they came out to inspect the tree, and thank God they cut it down because you look at the stump that was left. They got rid of the stump, but before they did that, you could see the inner rings of the tree was completely rotted out. So it was
Oh,
on its
it would
way
have.
down that it would have fell.
Oh, so it would have
And the
fell on.
storm was getting really, really bad. Like storms were
Yeah.
getting bad, and then it was shaking, and it was a hefty tree,
Oh,
but
wait.
it could have severely damaged our home, the home it was next to, our cars, and that's just learned experience. So on the next house, I know what to
You'll
do.
know. Yeah. Look,
But yeah,
I'm glad I wasn't there when that tree was leaning because it let it fall on my car. I'm suing the homeowner. I'm gonna sue the homeowner.
Well, the property was owned by the city, so city.
Oh,
It was
okay,
owned
okay.
by the city
Oh,
or
look,
a bank, one or the other.
good luck on the city.
Anyway, moving
Oh,
on.
let me take it. I need to
Moving
take
on.
these labels off my stuff. Okay, go ahead.
So I want to talk about some must know terms when you are buying life insurance or even some retirement options that are through life insurance. So your annuities, which are typically sold by life insurance companies. Um, a lot of these terms are uh, used, and you need to know what they mean. And also being with a broker, a good broker, um, that can explain these things for you. And even when you're going through, you'd be like, I know what that is. I listen to the Real Life podcast. So I'm
Famous
going to
for
explain some of these. Some of them they sound, what's the word I'm looking for? Like a duh, but yeah, we're going to explain them anyway. So the first
so
one,
wait. So wait a minute. So you're saying when I am trying to figure out if I need, that glare be bothering me. So,
this is
uh,
when you're getting life insurance.
so when I finally say, okay, I need some life insurance,
Yes.
but I don't want to be confused by what this person is saying to me. You're going to help me decipher the insurance jargon.
Yes. And
Okay.
even if you have questions for them, you don't have to be like, how much is that thing that helps me with you'll already know how much is the death benefit. You'll know exactly what that is. How much is the face amount, you know? So we're going to define those words. The very
Face.
first word is
You
the
said face amount.
the face amount. I can tell you
Yeah,
that the
the face amount. My face.
uh,
Okay. Okay.
not
Stay,
that. No.
stay
Face
focused.
amount, I'll start with that one first then. A face amount is your death benefit. That's the amount of insurance you're purchasing. So if you get a $500,000 policy, that 500,000 that is the death benefit that your beneficiaries will receive. It's called the face amount because when you finally purchase your life insurance, you get a packet, your policy. It's like 35 pages. The face amount is the very first page that says how much your death benefit is, which is why it's called the face amount. It's on the face of the page. They took it very literally. It's the amount on the face of the policy packet.
Because it's on the front. Okay.
Yeah,
Okay.
yeah.
Next.
And this second one is also kind of one of those things. There's something called a free look period. Now, your
You can
free
look for
look,
free.
technically,
Okay.
to a fault, because the free look period, say for instance, you buy your life insurance, right? And you did go over it with your broker, and then you're going back over the policy packet with yourself. The policy is in force. You're going back. Is it frozen? Am I frozen? Oh wow, disconnected. Okay, okay, I'm back. My screen froze. Oh, I'm gonna have to cut that out. Anyway, the free look period. So, say for instance, you get your policy, it's in force. You've paid your first premium, your first month's premium, which is the amount you pay every single month, just like the cost for anything else. And you went over your policy with your insurance broker. They told you everything. And you, about a week or so later, you're looking at it and you're like, you know what? I don't really like this. I don't really like how the interest grows. I don't really like some of their clauses in this policy. I don't really like this. I don't want this policy anymore. You can go back to your insurance broker or go back to that company and say, I no longer want this insurance policy. Can I have my refund? And you will get a full refund on your premium.
Hey, how long is this period?
In most cases, it's 30 days. So after you buy your policy, you get 30 days to decide whether or not you want it, and you can go back to your insurance company if you do not want that policy and get a full refund on your premium. And then your policy will be closed.
That's on all kinds of insurance.
On life insurance, yes. I'm not sure about other kinds of like home, auto, any of those, because I don't work in those fields. But I do
So
know
it's for term, whole life.
all of them. All kinds of life insurance. You have 30 days to look back, because it's also, some people also call it a look back period. You might see that somewhere, but more
I've
often than not,
seen looked at before.
yeah, it's either called a free look period or a look back period, and it's saying to look back, but you have 30 days to decide
Okay.
if that's what you want. After that 30 days, you cannot get your premium refund.
Okay, wait, 30 days from when you pay or
30
from
days
when
from when your policy is in force.
is that the same day that you pay for it though?
Not necessarily, because in some cases you can get something called a conditional receipt or a conditional pay, and that means that, say for instance, I am giving you your we're doing your application for your life insurance policy. If you want, you can go ahead and pay your premium that day. Um and you have insurance on a conditional basis.
Okay, based on
And if
conditional on the results of whatever you got to do.
exactly. And
Okay.
if you end up getting denied or whatever, they just give you that money back. But it comes with a conditional receipt. You have insurance conditionally. Um so that's why it's not necessarily based on your pay, because you can pay, that payment comes before your policy is enforced. So the 30 days starts the day your policy becomes enforced.
Okay.
Yes. Now, there's a couple different parties involved or people involved in your life insurance policy. You have the insured. That is the person whose life is being um basically paid for.
Covered.
If Yeah, that's the one you're being covered.
Okay.
So let's use you and I, right? You are the insurance company.
Okay.
If I'm the one that passes away, that make and you pay to my beneficiaries, I am the insured. The insurer is obviously the insurance company. You also have the payor or the owner. Both of those names are used interchangeably, or you'll also see policyholder. That is the person paying for it and whoever owns the policy. That's who that is. And it can be the same person as the insured, but it doesn't have to be.
So using this example, so when I was in the army, I had life insurance on myself, of course, on your dad, and on you and your siblings. So even though y'all had your own policies, I was the policy holder.
Were you paying for it?
Yeah, I was paying for all of the
So yeah,
insurances.
so in
Everybody
that
had their
case,
own policies.
you were the policy holder or the owner.
Okay.
All of us were just the insured.
Okay.
And
Okay.
if
Okay.
since you said you had insurance on yourself too, you also played the part of an insured
So I was the insured and the okay. But
and the
y'all,
policy.
but even though the policies were y'all were just the insured, not the policy holder.
Exactly. Yes.
But even though y'all could have y'all, it was y'all insurance though.
Yeah. We're just in the insured. That's it. We don't pay for
Okay.
anything.
Okay.
But you can think of the policy holder or the policy owner as the person paying for it, who is funding it. So, and especially like and I'm saying these terms specifically because when you look at a life insurance policy packet, it specifies those names a lot of the times. It'll say, like for my son, he has a life insurance policy. It'll say insured and it'll say R.A. Johnny, and then it'll say owner or policyholder and it'll say Robert Mitchell, which is my husband's name. My husband is the one that pays for it, but Ari is the one that is being covered.
Okay.
Yes. And then the last party I want y'all to remember is beneficiaries. Now that's pretty, everybody kind of knows what that is. It's the person that's receiving the money. However, there are two kinds of beneficiaries. Technically, it can go into three, but more commonly, you'll just see the two. They are your primary beneficiary and a contingent. And then if basically primary is, if we'll use us in this situation, If I'm the insured and you're my beneficiary, if I pass away, the money goes to you. Now, let's say you also pass away, then the money needs to go to somebody else. That'll be a contingent. That person will get the money if both the insured and the primary beneficiary is gone. Now, say for instance, the contingent is also gone. Then you have a tertiary beneficiary. That'll be the third person in line. It doesn't happen as often unless all y'all kind of went away at the same time. It's just that's so depressing.
Like Enoch.
Yeah, that's
He's no
depressing.
more. He's no more. Because
There's
God
no
took him.
more. So
Because God
yes.
took him. That's what the scriptures say. He was Enoch was no more because God took him.
So yeah, when everybody is no more.
Okay. Now I gotta put my glasses off.
Now we have to say something very, 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 very important when taking a life insurance policy out on somebody.
Wait, say that again. We
Yeah,
gotta do what?
I said we gotta say something very important when you're taking
Okay.
a life insurance policy out on somebody.
Oh
To
yeah.
make sure to make sure that people aren't just getting life insurance policies on anybody.
Hmm.
Like you can get life insurance for your neighbor. There is something called insurable interest. You have
Okay,
to
and sure.
have insurable interest in said person in order to purchase life insurance. Now, Ari, what is insurable interest?
Please explain.
I'm so glad you asked. I'm so glad. Basically, it means that you would be at a financial loss if that person passed away. That person's loss, that person's death, has to affect you in some way. So, for example, if I lost my husband, I have insurable interest on my husband. If he is gone, I will suffer emotionally, first and foremost. I don't know what I'd do. I'd have to hurt somebody, even if nobody did anything. I don't know what I'd do. But if I lost my husband, that would be at a great cost to me in
Yeah.
multiple ways. If I
Yeah.
lost my child, that'd be at a
Yeah.
great cost to me in a lot of ways.
Yeah.
If my neighbor passed away, that is not going to affect me at all. Therefore, I cannot take out a life insurance policy on my next door neighbor.
But what if your neighbor cut the grass?
No. A life insurance policy gonna look at you and be like, okay, we'll get another gardener, I guess. Like they
Okay.
don't know. So
Okay.
most commonly, oftenly is not a word. I was about to say most often, and then commonly came into my head too.
Hey, wait a minute. If somebody can put neglectic and lectic
That
in
made me
the
so mad. I don't want to talk about that.
you can put most oftenly in there, but I mean,
More commonly or more often than not, there we go. People take life insurance policy out on family members, and depending on the friendships, and on coworkers, like specifically business partners.
oh, okay. Because I'm gonna say coworkers. What?
Not just your regular coworker, but I mean like
Okay,
a business
business
partner.
partner. Okay,
Yeah, that's probably a
so
better
so if
term.
you're in a partnership with somebody,
Yes, and
okay.
that's an actual whole thing I'll have to get into in a different episode about
Oh yeah,
taking
yeah,
out
yeah,
business partner, taking out life
yeah.
insurance, not taking out business partners, but taking out life insurance on your business partners. And the reason why insurable interest is so important is because they're trying to prevent you offing somebody
I
just to get a life
mean,
insurance payment. I mean, you can do that to family, and it has been done many a time before.
yes, people run over people with cars.
Yeah, people do all kinds of stuff, and there are many movies about it. And it's typically the very first thing that people check when a spouse dies. They're like, when did they take out this life insurance? Oh, you took out a $2 million life insurance party a week ago? Oh, yeah, it was probably you.
Right.
But yes, they're trying to prevent that. Because basically they're saying if you don't care about this person, why are you getting life insurance? It sounds like you're only doing it for money. They're also trying to save themselves some money. So yes, that is very important. Another thing that two more things that are important when it comes to paying your premiums. Two words you got to remember. A grace period, or that's technically two words in and of itself. The grace period and lapsing.
Yeah, I was gonna ask about that.
Yeah, so a grace period. Say, for instance, you having a hard month financially, and your bill's due on the first,
Yeah.
and you like, I'm not going to be able to pay that. Well, in most cases, you have 30 days to pay your premium that and keep your policy in force without it the second term lapsing, which means the policy is closed. You no longer have insurance. So as long as you pay it within that 30 days, your policy will stay in force. If not, it'll lapse or just close itself. That's what that.
So if it lapses, you can't just be like, oh, I got the money now.
No, because technically you signed a contract that says you would pay it within, and once you don't pay it within that grace period, you void the contract. Because life insurance in and of itself is a contract that states as long as you pay these premiums specifically within this time frame, we will pay you this money at the time of your demise. And if you do not do that, you void the contract. So legally, they are obligated to take away your insurance. Sadly. Um. Now let's look a little bit deeper into a specific policy,
Okay.
and I'm gonna try and keep this short. A couple different things, and I'm mostly looking at permanent life policies. These are the ones that we said will stay in force. Most commonly, they'll stay in force till 120 years, but basically your whole life. I did see one that was only 100 though. So if you're 101,
Looks to be you.
I mean, I'm
Wait,
surprised you're here this long.
that's the thing. People are living
100 past 101.
109, 111. I've seen them both.
I think the
So what?
oldest person I've seen was 117, and I
So
was
like
like,
what? So what the? So the insurance. So if they had whole life insurance all this time, and they get to 110, insurance gonna be like,
actually,
really?
but here's the thing. What I think people should do in those cases, because at that point you would have built a substantial amount of cash value. I would just take all of that,
So
like
what?
empty
You
it out.
saying take it at 100? Is that what you're saying?
If it runs out, I would say empty out that cash value.
Okay, wait a minute. Wait. So it ends.
Like, get
So
off
the
the money.
policy, is till you're 100, right? That's what you're saying.
If that one is the one that's at 100, that would say at 99.
Okay, so you're saying when you get 99 and you still here, you need to go tell them to
Yeah,
run you your
don't
money.
lose your money.
Okay, so you need to tell them. So listen, let me take my glasses off so y'all can see my eyes when I say this. So if y'all have a family member that is got some life insurance and they are 99, and you
And
know
they
they
stop getting
still
coverage
cook,
at 100.
they still cooking, they still in the garden, they still bossing people around.
And it's a bunch of them like that.
Tell them to tell the insurance company to run them their money.
Yeah. I
Mm.
might want to, I'm probably gonna, because I have not met anybody that's in that situation. And like I said, most commonly it's 120. Like I said, I only saw one company that's 100. But
Okay.
anyway,
Oh,
back to these
okay. Yeah.
terms.
Talk to an attorney. Don't listen to me because I'll
And I'm gonna get to an attorneys in a second too.
talk
Uh,
to an attorney. Okay. I had to say that to the camera.
yeah, we'll talk. I'm gonna mention that in a second because we talk about it a lot.
Okay.
One term living benefits. We briefly mentioned it last week when we were talking about riders.
Mm-hmm.
A living benefit is basically you get having access to the money in your policy for certain illnesses. So if you become ill, um, or ailing or disabled in any of those cases, you get a portion of that money. So living benefits will include like a long-term care rider or a terminal illness rider, critical illness, critical illness, chronic illness, something like that. If you become disabled for an extended period of time, you receive a portion of that money. There's other different types of living benefits, but that's what that is. And if that's something you're interested in, then you need to mention that to your insurance broker. What type of living benefits does this offer? Does this company offer? Because it can be very helpful. Um, Now, I know we also talk about the cash value, which is what one of the biggest things that separates term from permanent is that cash value. That's that money that grows over time. Uh, One, how does it grow? And two, how can I touch it? Because I know that's what a lot of people be wondering, like, how can I get that money? And how is it actually growing? I know I'm putting money in there, but sometimes it grows way faster. It's a couple different ways. I'm only going to talk about one because the second one gets a little difficult. One is a dividend. And for anybody who is in the stock market, you would understand kind of what, or if you own a company, you would know what a dividend is. It's basically a portion of profits for that company, and it gets paid out to shareholders and all that kind of stuff. For you, it works in a similar way. It's a portion of it's based off the company's product profits. It's based off, and it's also based off your premium. So it's like a tiny portion of your premium that comes back to you. That's what a dividend is. And you also have a dividend option, basically giving you the option to do with it what you will. You can let it sit and grow interest and just grow. You can use it to reduce the cost of your premium, or you can just take it out as cash. So you would have to talk to your insurance company though to see what they allow. Different options, all that kind of thing. And the other part is, how do I get that money? Because I want it. Yes, that is the most common thing people do is take out a policy loan. Um, and basically you take out that money, and the money that is sitting in your the money comes from the company, comes from the insurance company, not out of your cash value. It's based on how much is in your cash value, but it's coming from the insurance company themselves. And your cash value is held as collateral.
So they're basically giving you a loan.
Yes, that's exactly it. It's a policy loan.
Okay.
Now, you technically do not have to pay this money back. And there are no taxes when it comes to this because it's a loan. Um, However, if you do not pay it back, then it comes out of what your beneficiaries will receive when you pass away. So you technically don't have to pay it back, but if you don't, it comes out of the final portion. That's your
So if I have a $500,000 policy, I borrow 125, then when I am no more,
your beneficiaries will get 375.
beneficiaries get 375. Okay.
Mm-hmm.
Okay.
The other way that that's the more common way and most tax efficient way. Um, and like I said, we'll get more into bigger details when I talk about some of the other types of policies. But the other way is a withdrawal, and that comes directly from your cash value, and there are taxes involved with that one. It's not as common, but it is an option for you if that's what you want to do. So those are your main two. And I said I was going to talk about the attorneys. This is just another quick PSA because a lot of people don't know. We keep saying talk to an estate attorney. It is very, very important, and it's also talked about a lot in the same realm of life insurance because both of these things determine what happens after you pass away, where the money goes, what happens to anything in your estate, and you can also, if you have a will, power of attorney, all of those kind of things, you can tell them how you want money to be spent, where your money is going to go, how it's going to go, all of those things, and a state attorney can definitely help you with that. And like I said, it's also talked about in the realm of life insurance because both of those things are for when you are no more.
So, and you need to put your real estate in some kind of trust or an estate.
Yes,
So your um siblings, your children will not fight.
it makes things a whole lot easier.
It
And
does. Oh, I
two
want.
last quick things, and then we can get up out of here.
Okay.
Um, this one is more important for annuities. In one of my Instagram videos, I talked about how annuities are taxed when it's time, which is real quick, and it's annuity is a retirement option. Uh, it's typically funded or typically bought with life insurance companies, but it's a retirement option, and it's specifically for retirement. You put money in. When it's time for you to retire after 59 and a half, you get that money back. If you get it before, it follows the 59 and a half rule where you get a 10% penalty. But in my Instagram video, I talked about how those are taxed If it's a qualified annuity, meaning it was funded with an IRA or a 401k or a 450, like one of those kind of things, then the tax rules are based on whatever account it was funded with. If it's a non-qualified annuity, it means it was funded with your own money. However, wherever, if you want to put money in there, that's what it's funded by. Now, there's something called a cost basis. Your cost basis is how much you paid in premiums. So, say for instance, you paid, let's say if your end result was $500,000, right? You paid for in insurance or in this annuity $300,000, and it grew $200,000. The cost basis is that $300,000. Now, Ari, why is a cost basis important? Because of taxes. You will not be taxed when it's time for that distribution. Like, and this applies for like cash, like other insurance policies too. Time for taxes, you will not be taxed on what you put in there, but you will be taxed on what you gained. So that 300,000, that is the cost basis. That's what you put in there. Those gains, that 200,000, that's the interest, the dividends, whatever, all of that stuff, you'll get taxed on that.
So you get taxed on the 200, not the 300.
Exactly. And so it's
Okay.
really, really important that when you're planning things out, like how much you want to take out, all of those things, you need to know what your cost basis was so you know how much you're going to get taxed on interest and the dividends and that the gains. That's what they say specifically. You get taxed on the gains or the growth. So it's very, very important so you're not either overspending in your head or underspending so you can know actually how much more you're going to get. So it's very important to know that. Um,
So you need, so here are the people that you need on your team. Let me take my glasses off so y'all can see me good. You need uh, an estate planning attorney. You need an insurance broker. You need an accountant, and you
yeah,
need a real estate, and you need a real estate broker. You need them 4 people.
because they all work together.
Yeah, but you definitely need an attorney and a CPA so they can make sure that when you talk to the insurance broker and the real estate broker, that the math is mathing.
But sometimes math don't be mathing and you need the math to math.
Well, the only time it don't math is when you try to do it yourself because you watch something on YouTube, but that's neither here nor there. Thank you, Arian.
Oh, 30 seconds.
Okay, 30
People
seconds.
always want to know how the life insurance companies make their decision because some people will get like, oh, how come I didn't get
Oh, you talking about
approved
denial or for a loan?
for
I mean, denial of insurance or denial for a loan?
denial for insurance?
Okay.
Is so there's something called a MIB, which is a medical insurance bureau. That's a database of all of everyone's medical records. That's where insurance companies go to get your information. They check your entire medical history to,
So it
yeah.
sounds like the credit bureau of the insurance industry.
Yeah. Yeah.
So every time, so we're gonna talk about this next time because we are way over. But
Yeah.
so every time you go to the doctor, every time you get some kind of diagnosis, every time you get some medication, it goes to the medical insurance bureau. That's what you're saying. That's what you're trying to tell me.
You look so disturbed.
I am.
I mean, all of our information is somewhere.
I mean,
Hell, I
I
do think
know
they only
that,
keep
but
it for a
to
set
say it out loud,
amount of years. I need to fact check myself though. If I do, once I get the
I'm
answer, I
about.
might insert it here.
You know, I'm about to.
But
I'm about to
I do. If I remember correctly, they do only keep it for a certain amount of years. But regardless, that's how they're getting your. That's aside from attending physician statement, which is the statement that is like the most recent everything or whatever, and outside of your medical exam, they get your history because like a lot of things they check back at least 10 years to make sure you don't have like cancers because a lot of policies won't allow you to get a policy. A lot of insurance companies don't allow you to get a policy if you had cancer within the past 10 years.
To me. Okay, we're gonna talk about this next time because you know. Let's last one. Thank you, Ariane. This is
Thank y'all for tuning in to our very long episode.
Thank y'all so much. We hope y'all learned something. Hope y'all took away something or we said something that you can apply to your life, not to nobody else's life. And that's what
Hope
I
your
mean,
hands aren't
I
hurting
was,
from all those notes that y'all were
yeah,
taking.
I was about to go to the Bible because when you read the Bible, you're supposed to read it for you, not so you can tell somebody. See, it say right here. See, it's for you. It's
Right,
So we hope you learned something for you that you can apply to your life.
right.
Thank y'all so
Thank
much.
y'all for tuning in. We will see y'all next
See
week.
y'all next time. Bye.
All right, y'all. I hope y'all took plenty of notes on the pen and paper. Plenty of notes about some first time home buying experiences. And know that your first home is not probably going to be your dream home. It takes time. Like the lady in our example today, it took her 10 years, but she got it and she earned some equity on it. And also stay off Zillow because you don't want to set yourself up for disappointment. And now also, when you are going to buy your life insurance policies, you kind of know some of the words that you'll need to know or need to understand. So when your broker is talking to you, you already know what they're talking about. Of course, you can always connect with us when you're ready to buy your first home or when you're ready to get your first life insurance policy or more if you need so. Connect with us on social media. For my mom, it's at the Shanita Johnson on Instagram, Facebook, and YouTube. That's SHANITA. And send all of your questions to her email with the subject, The Real Life, to Shanita@ShanitaJohnson.com. That's SHANITA. ShanitaJohnson.com, and then you can come to me for all your life insurance needs. On Instagram, that is raj.john. On TikTok, ari.j.john. And on YouTube, Future Planning with Ari. And you can email me for all your questions to ariyanjohnson@gmail.com with the subject The Real Life. That is ARIYANJJohnson@gmail.com. Thank y'all so much for tuning in, and we will see y'all next week.